Everybody, welcome back to another episode of Cash Flow Positive. I'm your host, Kenny Bedwell, and this week we're doing a part 1 and a part 2 series on knowing how to invest with the exit strategy in mind. I really wanted to focus on, especially for those of you who are new and listening to the podcast, welcome to your first episode, or if you've been listening for a while, welcome back. But today I really wanted to focus on how we should be investing with the exit strategy in mind. And that's going to be the theme for this week. I've got a really great guest who's been investing for a while, and he's going to get on and talk about how he invests in real estate with the exit strategy in mind first and foremost. One thing I've realized with short-term rental investors is they're also very short-term sighted, meaning that they're constantly looking for ways to invest for the benefit of today, but not understanding the true benefit of, the future and really that we're building wealth. Okay. And so on today's episode, we're going to dive into the 3 things that I see, whether they're mistakes, but really 3 key points that investors need to think about when approaching investing in short-term rentals or just real estate in general, with understanding the exit side first and then working backwards from there. So let's start out with this, and it's really interesting. It's like why most investors build backwards. Most actually don't. And that's kind of the interesting thing. Most investors, but serious investors do, whether it's fund managers or, I didn't say fund manager, like serious, like serial, real estate investors who do syndications, other large style assets. They are buying for a purpose. Okay. Obviously purpose make money, but it's more specific, and they have timelines. And the timelines are really critical before they get into a deal. And so, meaning they have clearly mapped out what their goals are, what they're trying to buy, what they want the property to generate income, but more importantly, what the exit strategy is. Most short-term real estate investors don't do that. They buy either for tax savings or to make money. And that's probably why you're listening. You're like, hey, Kenny, I want to cash flow. Therefore, I'm buying property to cash flow and maybe get out of a W-2 or other things. But they're not thinking about this idea of the exit strategy. Here's an interesting stat. Most short-term rental real estate investors sell their properties within 3 to 5 years. That's it, 3 to 5 years. So this idea that you buy a property, you buy 5 properties, 6, 7 properties, all at the same amount that all are going to cash flow the exact same amount is not realistic. Okay. It doesn't work like that. It works in tranches or steps, meaning the first property helps us get to the next one, and the next one helps us get to the third one. But the first one will be sold at some time, at some point. Most people think that they're going to hold on to that first property forever. And if it's your dream property that you're going to use as a lifestyle investment and you're already a multi-millionaire and it's a big, awesome, then this podcast is not relevant for you. But I'm talking to the investors out there who are looking to grow their portfolios. Property number 1 will not be in your portfolio for very long. I know my first short-term rental property is not in my portfolio anymore. Okay. My second one's not even in the portfolio anymore. They get sold. You level up. Okay. And so it's hard when you're sitting at the ground level with no properties or even one property going like, okay, how am I going to level up? Why would I get rid of my property to level up? But the reality is the secret to short-term real estate investing isn't the cash flow, it's the appreciation. Okay. The majority of us will make most of our money when we sell the asset or exit the asset. Now, it could be a reposition where you refinance. Okay. We've talked about repositioning being refinancing or selling, but for most people, it makes more sense to sell the property, meaning that at a certain point in time, you will have enough appreciation that just is a crazy amount to outweigh your cash flow. I talk about our return on equity, ROE. That's the metric, meaning like how much equity do I have in the property versus the cash flow, the yearly cash flow that property is getting, the net or the profit at the end of the year, right? So if you take those 2 numbers and you divide the cash flow divided by, so let's say you're cash flowing $20,000 a year, and your equity in that property is $200,000 a year. You take 20 divided by 200, that gives you 10%. So that means that you have a 10% ROE. Anything less than 20% is usually assigned to sell. Okay. Now, you got to think about this too in another light. All right. Because the ROE thing, that sounds great. That's a very metric driven way of thinking about it. And obviously, if it's 10%, or, like 15% or whatever is my ROE, I should sell the property because I have more equity, because it would take you 10 years in cash flow just to hit that equity amount. So now you have debt equity and you need to get it to work, right? But here's the kicker. There's a couple things you got to be cautious of. Number one, what did you buy the property for? So if you bought $1 million property, it's only cash flowing $20,000 a year, and now it's worth $1.2 million. Okay, so you only have $200,000 of equity plus whatever your extra from your down payment, all that. But we'll just say $200,000 of equity. You have to roll those funds if you're doing a 1031 to avoid capital gains tax into the next property that's at that sales price of 1.2 million or higher. Okay, but you have to do at least 20% down. So all of your 200,000 is going to be rolled in that property. You have nothing left over to reinvest into the property, and you don't even have enough. You don't have 20% of 1.2. You only have 20% of $1 million, right? The 200,000. So in this example here, it doesn't actually make sense for you to sell from the ROE perspective, right? Unless you're bringing in outside capital to find a better investment. And in that case, probably, but $20,000 a year, it might be better to hold on to the property longer until you hit a certain sell trigger. Okay. Now, that's a very broad, there's other situations where you might need to sell. Maybe revenue's been dropping and you kind of see the writing on the wall and you need to get out now, and it's okay to, sure, by all means. But from an ROE perspective, just because 20K cash flow, 200,000 in equity doesn't necessarily mean you have to sell the property given purchase price as well. So keep that in mind when you're thinking about that equation, because that never gets brought into the conversation. But for most people, that's not the situation they're in. They have a lot of debt equity and they're making okay cash flow, but the reality is they probably could be making more. Okay. The second thing you need to think about too is, okay, $200,000. So I'm going to go back to this $200,000 20K cash flow. Can I make more money, more cash flow if I reinvest the equity? That's the next question you have to ask yourself if you're thinking about selling. Okay, so if I'm only making $20,000 in cash flow, can I take $20,000 or $200,000 and turn that into $40,000 in cash flow, $50,000, $60,000? That's a question for you to answer, unless you're hiring me to answer that for you. In that case, I would tell you, yes, you can. You could probably net at least 30 to 40K, which would be double what it was earning before. Awesome, right? And that's how you scale. That's the process, right? So the first thing we need to understand is that when we're investing and thinking about the exit strategy to begin with, we need to understand that first property, we're going to use it to level up. Maybe it's to the fourth property or the fifth property, or maybe it's even just to the second. But the reality is we won't hold on to that property forever. Okay. So if we understand that key concept, then the next step becomes a lot more clear. So number one, and I also want to preface something here too, is most investors get into the short-term rental space for the tax savings. And although there's nothing wrong with that, it's very short-sighted. Meaning that, yes, the tax savings are excellent. However, it's for that year. That means you have to buy another property the next year, and then the property after that, the year after that, just to get the same kind of tax savings, right? But what goes on with property number one doesn't even cash flow. But number two, what was the point besides that short-sighted 1 year of buying that, the tax savings for getting that property? So that's the mistake that people find themselves in. And then they go, okay, crap. Well, Kenny said I should sell it in 3 to 5 years. So I'll sell it in 3 to 5 years. But why? Why were you doing that? So step number two, when you're thinking about all this, is understanding the why. Like when you're trying to create your exit strategy, why are you buying this property besides the immediate benefit today? Okay. Now, obviously, guys, I understand. I have these conversations with people all the time. They're like, well, Kenny, I just don't want to pay taxes this year. I really just don't want to pay the government. Okay. And they're like, I'm willing to put in the time. I'm willing to make an investment. All right. Now we're heading the right direction. Right. I'm willing to figure things. And that's where we start go, okay, now when you say a good investment, why? What is a good investment for you? There's cash flow, there's appreciation. These are all things besides tax savings that we have to think about. Why are we buying this asset, this investment, besides the tax savings? Okay. And there's going to be a lot of and then what would make you sell that property for good or for worse? Not necessarily for worse all the time. Well, if it wasn't making any money, I'd sell it. Okay, sure. But if it was making money, at what point in time do you reevaluate and say, okay, the market cycle has shifted. It's time for me to sell that property. See, market cycles work on between a 5 to 7 year basis. They change over 5 to 7 years. Okay. We had COVID, right? And things are starting to settle. COVID was over 5 years ago. All right. And we're seeing this change. Interest rates are, the market's like, they shot up and then now they're kind of like plateauing in this weird, like high 6s to 7s range. And they'll kind of dance around that, right? But they're not going to really, really drop and they're not going to really, really climb. It's going to be in that run unless something serious happens, which will which will cause another market shift. But the point being is that we need to plan for indications in the market to sell. I'll give you a really good example. When I go into a new market, especially a market that is less on people's radar, in terms of short-term rental investors. And here's the thing too, I understand, this is important for me. I understand I have the power to move markets, meaning I can tell people about a market and people will swarm that market. I can tell people about the success of my property and how great it is, and people will swarm in that market. And essentially what I can do is saturate a market with investors. Okay. If I know that, then if I'm looking to buy a new property, I have to keep that in the back of my head because I'm going to talk about it, right? I'm not going to hide it from you guys, but then people are going to invest in that market. So what do? Well, number one, I have to look for crazy unique properties, but remember, I'm not thinking short-sighted. I'm thinking long-term here. And I'm thinking about my exit. I'm going, okay, well, if I go into this market and I pay, let's say $1 million for a property, okay, and then all these other people swarm in, what's that going to do to prices? It's going to shoot them up, right? So that means that at a certain point in time, maybe in 2 years or year 3, my property will artificially be worth more, a lot more, because of the number of investors going into a market. It's a compounding effect. So like, sure, okay, Kenny talks about that market, but then somebody else, a friend of a friend, hears about that market and they invest there. And it's really interesting to hear this actually does happen. And it's happening in some of the markets I've invested in where it's like, I put a client in that market with me and then they told their friends and their friends just bought some random place there to do the exact same thing because people are unoriginal and they just they're buying. And then that person hears from somebody else and, so on. And as these people are successful year after year after year, within a 2 to 3 year time period, that market blows up, right? We've seen this happen in Newry, Bethel. We've seen this going on the Bourbon Trail right now, Asheville, North Carolina. And I'm not saying like I'm the only one to blame, but like, it's a chain reaction. Okay. So these things happen. And if you're the first one to get into the market and you know that these things can happen, okay, how should you prepare for that besides thinking about purely the moat? The moat's important. And I'm not saying don't think about the moat being different from everyone else, but how should you think about how investors, when the crowd of investors are going to rush in, what would you do differently? You would probably think about selling a lot sooner. You would, right? That's exactly how I approach it. I go, look, I'm probably going to have this property for my sell cycle is going to be 3 to 5 years, meaning in 3 to 5 years from now, because of the amount of investors that are going to come into this market, because this property has been successful, and then all the other properties coming in and they're going to be successful because of that, I will have probably almost doubled the value of this property. So we bought a property for $1 million. I saw a sales comp a couple months ago of a similar size, all this other's like very similar. We bought a property for $1 million. The comp just sold for 1.8 million. 1.8. Okay. Let's assume that I could get the same value for my property and sell it to an investor, because if I'm still making money, I can sell to an investor. And that's the thinking. I'm not thinking I'm going to sell to somebody for their residential home. I don't care about that, right? Sure. So if someone wanted to buy it for the residential home, sure, but I'm not making residential homes out of these properties, right? So I'm buying and I'm planning to sell to an investor with my cash flow. So I get the numbers together, and then there's comps that actually show because we have to go off residential comps, 1.8 million. I have $800,000 of equity in 2 years. 2 years. This property nets $175 a year. That's pretty freaking good, right? However, I got $800,000 of equity. That assumes someone would buy it for 1.8, and that assumes all lending and all these other things work out. I understand that. but there is a comp at 1.8, right? So now I'm starting to see these signs because I knew going in that people would come in and investors would artificially inflate the market. That's what happens. That's what happened in the Smokies. That's what happened in Orlando and Scottsdale and all these big popular markets is prices have been artificially raised by the influx of investors trying to buy bigger, do better in top. That's natural investing cycles, right? So when we hit a certain number, 2 million is the magic number, by the way. We hit 2 million, we've doubled our equity and we're out. We're done. Like we're gonna sell the property. And that's probably gonna be year 3 or year 4. Okay. We knew that going in. Okay. Now there's a side where it's like, well, how did you know that? I mean, it is our thesis. And that's kind of what I'm telling you to do is like, when you're thinking about the deals here, you need to have an investment thesis of like, when I, at a certain time period, when the property is worth X, I need to sell. Okay. And you're reevaluating once or even twice a year to see if your property is at that point, right? Because there's a goal and there's a purpose. Okay. Sure. The Kentucky property is doing great and it's a great cash flowing machine and it's wonderful or whatever. And if something's going on with the market and we just don't feel like we could find something better, then yeah, we will hold on to that property a little bit longer. But when we hit that point in time, that sell price, at what point does it make sense to you to go sell that property at what number? What number is that? That's what you got to think about all of your properties, all of them. You need to have a number that you look at and you're like, yeah, I would sell if it hit this number of worth. Okay, that's a serious question because guys, I'm telling you, a lot of you would be surprised on the fact that you could sell your properties for that price point. Okay. And it might be having a conversation with your agent, or you can reach out to me and say, hey, what do you think of this? And this is what the property's generating. And I could tell you, yay or nay. I've had some people do that and I'd be like, yeah, I could actually find you someone who could buy your property. So don't be surprised. Like, you got to think about that number. What's that number that I would sell the property at? That's how we're thinking about the exit strategy, right? Now, ideally, you're thinking about this before you even buy a property, but even if you already have a property, that's what you can think about as well. But we need to understand that number one, we're doing this to build wealth, not purely for cash flow, but it's to build wealth, long-term generational wealth. And to get to the next level, you have to appreciate. Cash flow is only going to take you so far. Okay. Netting, most of us are going to net $50,000 or less on properties, right? And $50,000 is still $50,000. It's nothing it's something trivial, but it's also nothing like, it's not 100,000. It ain't 200,000. It's not 500,000, right? But we can get that money back out of our own properties and scale up if that's what we desire. And that leads me to the last point here is understanding like what your purpose is when you're going into real estate. So when you're thinking about the exit in mind, you need to be thinking about like, why am I investing in short-term rentals to begin with besides the tax savings? Like purely from am I trying to do it to get out of my W-2? Am I trying to have a better life for my family? Am I trying to have more vacation time? Like what is my purpose? Because what happens is if you're purely just thinking about cash flow and you're like, I'm trying to leave my W-2, so I just need to cash flow as much as possible. Okay, fine. That's fine. I get it. So you buy property number 1, then you get to property 2, then you get to 3, and then at some point you get stuck. But ideally in your head, you're like, I have to keep buying properties, and it becomes quantity over quality. And what you end up doing is creating yourself another job. When you have no exit strategy in mind, you create another job for yourself because you're just buying properties and there's no end in sight. You basically transition from time over at this W-2 to now time into real estate investing and short-term rental investing to get the same value dollar for dollar, right? Now, for a lot of us, that's probably okay. We're like, look, I'd rather be investing in real estate than dealing with people. Sure. We kind of are dealing with people in the hospitality industry anyway, but you know what I mean? Like just dealing with less people or whatever you do. Okay. And that's okay. I'm not saying that's wrong, but for a lot of us, we want to move from this like active income sector into more of a passive side. That's the ultimate goal, right? Well, short-term rentals aren't really passive. They're active. So we have to be careful if we're choosing the short-term rental route to go, I'm just going to keep buying property, because in reality, it's just loading up on our active bucket, when in reality, we should be building up for our passive bucket. How do we build up for our passive bucket? By quality over quantity. So you're buying property number 1, but at a certain point in time when the property is worth X amount, you're going to sell it and take that appreciation and roll it into a bigger property. And what that allows you to do, because you will spend the same amount of time on a smaller property as a bigger property. I'm not kidding. Bigger properties, 10 bedrooms, guess what? The guests coming, yes, there's more guests, right? And they're bigger. There could be more maintenance issues or whatever. I understand that side, but you're not fixing the property. You're hiring someone to do it. But the guest communication is exactly the same as a 1-bedroom property. They both get a check-in message. They both get a checkout message. They both get, how are things going? All this stuff. They might respond. They might not. It's the exact same time. So instead of focusing on, I just need cash flow, we also need to be thinking about the appreciation. Appreciation triggers, meaning when I hit a certain cycle in the market and my property is worth this, whether it's because of artificial investing or because the market has shifted up for my market, awesome. I need to sell it and I need to level up to something bigger that cash flows more and generates more wealth for me over time, which will help me in turn achieve my goals of leaving my W-2 or having more cash flow for time freedom or whatever it is. Okay. It's not about buy property number 1 at 800,000, buy property number 2 at 800,000. They both cash flow at 50,000. Then property number 3 is the same, property number 4, and so on. That is not realistic if you want to hit your goals. You will run out of capital and you'll also create yourself another job doing that. Okay. Now, 5 properties, 6 properties, 7 properties, whatever that number looks like, that's going to be up to you and your investing journey and whatever your goals are. Okay. I can't tell you what that number is actually going to be unless I know who you are and what you're trying to achieve. But the reality is, when we start with the exit in mind first and we build backwards, we're really building for long-term wealth and gain and cash flow. I understand the short-term side as well, and that you will get that in the tax savings and all that. But we're really planning it out so that we can better achieve our long-term goals. Okay. We're really good at hitting short-term overall. We're really good at hitting short-term goals and, oh yeah, I cash flowed $40,000 or whatever, having awesome properties. We're really bad at mapping out long-term goals, really bad at it because we're not thinking like that. We're thinking, how much can this property make me tomorrow? And how much can it save me in my taxes? Hear it all the time. And that's normal because we don't have that financial education that other investors that have been doing this full time for many, many years and have gone through many, many cycles understand. And that's part of my goal in this podcast is to introduce these concepts to you, teach you these basic principles, and then bring on people who are doing this, which we're going to have on the next episode with our guests who are going to break this down for you. And so I hope you found this useful. And guys, you can find this useful before you buy. I try to approach this from multiple scenarios of you already have a property, you don't have a property yet, you're thinking about your first one, you're thinking about your third one. We understand the concept. You can learn these things while you're going. What do you think I'm doing? I'm building the plane while it's flying, right? We've gone from like a Cessna single prop airplane. Now we're like in a jet. Okay. And, and it's transformed in the air, not on the ground, in the air. And that's how a lot of this goes. And so I want to help you build your plane, whether you're currently flying or you're about to take off. Let's build your plane. So I hope you enjoyed this episode. I do want you to show up for the second episode here and hear from an experienced investor who's been doing this for over 2.5 decades and hear how they invest in properties with the exit strategy in mind. My name is Kenny Bedwell, host of the Cash Flow Positive Show. I hope you enjoyed this episode, and I'll see you on the next episode of Cash Flow Positive.